Welcome back, traders and investors. We have David Peltier here. He has joined TheStreet.com as a research analyst, and he likes to write street stocks under $10, and he also files and writes the Dividend Stock Advisor. David, how you doing on this Tuesday morning?
I'm doing fantastic, Joel. Thanks for asking me. Yeah, it's definitely a diverse group of stocks we look at, but both the small caps and the more the blue chip dividend stocks are both very much in my wheelhouse.
Okay, and how did you decide to focus? I mean, some people had like to focus on stocks under $5. How did you decide to focus on stocks under $10?
So the stocks under 10 story was really born about 10 years ago. It was something that Jim Cramer helped us develop. The idea being that the retail investors have always been drawn to low dollar stocks. Folks would much rather own 100 shares of a $5 stock than they would, say, a share of Google, even after the recent split. And I think that's one of the reasons why you've seen so many splits as we've seen with some of the larger companies out there in recent days. But the real reason, it's not psychological. The real reason we are involved in these companies, it's because they're underfollowed by the rest of Wall Street. And because of that, we feel that by doing the work and really digging in, that we can find companies at a much cheaper value, not just because they're trading at $3 or $4 a share, but maybe a company that's trading at 8 or 10 times earnings when the rest of the market's trading at twice that much. And by getting in early, we found that over time we can get a bigger gain out of those.
And so when they get to $10, do you sell them?
In a perfect world, we would hold them to 100, and in some cases we've held some stocks up to maybe $20 or $30. But we manage these stocks in the midst of a broader portfolio. So last year, when the Russell was up 37% or so, we made 43%. And we were taking gains all along the way, and it felt like every time we sold a stock, it would continue to go up. We hold about 20 to 25 stocks in the portfolio, and generally when I sell a stock, I'll keep it on my screen for a couple of weeks. But honestly, I was driving myself nuts because we'd sell a stock at 12 or 13, and then a week or two later, it's at 14 or 15. So right now, we're holding a bit of cash, not because we're bearish on the market per se, but because, frankly, we were able to take some good gains in the last 6 or 12 months.
Do you seem to notice that it kind of goes in sectors, and like all of a sudden, you're getting everything in one particular sector kind of popping up on the radar, or do you find it's more diversified where you're scanning the entire universe and you'll get one in this sector, one in the other sector, and just kind of play it accordingly?
That's a great question, Joel. I think you've seen just in the few months of 2014 so far, you've seen how important it is to be in the right sectors at the right time. In January and February, some of the biotech stocks we held were just rip-roaring, and then all of a sudden, you couldn't touch anything in that sector through March and April. And same thing with the cloud stocks, the software as a service stocks. They were the hottest thing going, and then people didn't want to touch them. And that's why we really preach diversification within our portfolio. Something that's really helped us out just the last 2 weeks or so is having a steady presence in material stocks, whether they be oil companies, whether they be gold companies. Gold especially, no one wanted to touch for most of the year. And you see a stock like a Yamana Gold, which was just added to the focus list over at Canaccord this morning. Now everyone wants to buy it all of a sudden. No one wanted to buy it when it went from 10 to 7. Now it's gone from 7 to 8, then now everyone wants it all of a sudden. So, yes, as a group, the small cap stocks do tend to trade together, but you're never going to be immune from the big sector shifts that we see, frankly, in all classes of stocks.
Okay, so you also like to focus on dividend stocks, and that probably hasn't been a bad strategy. I mean, even if you've as opposed to having your money in the bank, some of these stocks that are paying a nice dividend also have appreciated nicely, as far as the principal. But on the other hand, when a stock's paying, too high of a dividend, you're thinking, there must be a reason for that. There always is a chance that if they cut the dividend that, people are going to exit the stock. Could you just give us a few of your criteria for when you're choosing dividend stocks?
No, Joe. So, yes, this is very important. Like you said, a lot of times people will reach and try and chase the highest dividends out there. So in general, we look for dividends that yield at least 3%. But more importantly, we're looking for companies that can grow their dividend each year. There's a very select list of stocks that for the last anywhere from 20 to the 50 or 60 years raise their dividends consistently every single year. Altria is one on that list. Every August, you know that they're going to be able to raise that dividend. So not only are we looking for growth, but we're also looking for sustainability of the dividend. So in general, in the S&P 500, companies don't tend to pay out more than 50% of their earnings in dividends. So the inverse of that is a company earns at least twice as much as they pay out in dividends. So that's really the baseline that we set. A company that can raise its dividend consistently. And if the earnings are at least twice as much as the dividend, even if the company has a bad year, they're probably not going to have to cut the dividend. They can probably sustain it in the meantime. Because again, worst thing you can see, the worst thing you can see, I can't stress this enough, is for a company that cuts its dividend. Very rarely does a company or a stock really ever recover from that.
Right. And also, if you're talking about dividends, you got to be talking about interest rates. If you're talking about interest rates, you got to talk about the Fed, quantitative easing, Fed meeting this week. I mean, really, the market's really not going to get rocked, or these dividend stocks are not going to take a hit until people have another place to put their money. So could you just give us your short-term and long-term outlook for interest rates?
No, I think it's clear that the path of least resistance for interest rates is higher. We're going to see the spread between the short term, as they'll stay around zero, and the long term is going to get pushed out a little bit. But it's been about a year or so since we've really started talking about the taper, and dividend stocks did take a hit when the 10-year went from the mid 1% to the mid 2%. But since then, we've seen a bit of stabilization. And I think at the end of the day, people are really gravitating towards growth. I'm just going to pull up what the markets have done year to date. The Dow Jones Select Dividend Index is up almost 7% year to date, where the Dow 30 is up 1%, the S&P is up 5%. People are clearly not shying away from dividends, especially because that's where the growth is. And frankly, dividends are more of a fact of the market. When we first started looking at the Dividend Stock Advisor 10 years ago, some 300 to 350 companies in the S&P paid a dividend. Now it's 430. We're at an all-time high. Technology companies didn't pay dividends. Now it's really a matter of life. It's hard to avoid dividends, even if you're not necessarily buying a stock for that yield.
What do you think about a company like Apple that for all these years doesn't pay a dividend, and then after the passing of Steve Jobs, they do? I mean, now it's kind of shift focus from a tech growth company to a dividend company. Does that you think that's what they needed to do to keep the momentum going, or how do you look on that kind of move?
My honest opinion is that Apple got bullied into paying a dividend. I don't think they need to pay a dividend. I don't think they're really attracting any new investors with that dividend. Apple's obviously a fine company, and as an investor in Apple, if I did own the stock, I wouldn't mind getting a 2% dividend yield for it. But I don't really think the company gets much benefit from it. Obviously, the company's flush with cash, can afford to do so, but in general, with tech companies, if Apple's not, I don't think, the problem for Apple is paying a dividend for me is that I don't think Apple's really matured yet. I think they're still growing. I think a better place for them to invest that money would be into acquisitions. So again, I'm kind of neutral on the Apple dividend. Obviously, they can afford to pay it. They'll afford to grow it over time, but I really don't think they need to as a company. I think that money can be used better elsewhere.
Okay, can you just share a few of the stocks under $10 that you're either currently in or maybe on your radar over the next week or so?
Sure. So one that's been pretty hot of late, and I'm going to mention it because they just attended a fantastic investor and analyst meeting with them yesterday, is Therapeutics MD. Ticker there is TXMD. And I think they're really going to get back on the radar of Wall Street. That's one of those biotech stocks that I had mentioned before that was really hot in the first couple months of the year, and one that had obviously cooled off when the whole sector, when that IBB ETF just got blown up in the months of March and April. But you saw JMP Securities just picked up coverage of the company today. They held a fantastic analyst meeting here in New York yesterday, and I think that's one that's going to do relatively well. And another one that I know this is a very controversial space, but there's actually two companies in the home building sector that I think this is the time of year that there's two companies that I'm looking at. First one is Builders First Source, BLDR. The other one's Standard Pacific. Now, they're an actual home builder,
Yeah.
SPF. And those are two stocks that I think they're a little down in their luck. They're both trading around the $7 to $8 level. And I think by the end of the summer, you could see them closer to the double digits. I think I agree that that's a more controversial stance, but that's one that I don't mind buying those two stocks when they've been knocked down a little bit.
Okay, and if we're talking about stocks under $10, we obviously have to mention some stocks in the marijuana sector. Is that something that you're following? Do you have any stocks on your radar in that sector?
You know what? It is something we're following. It's something that on our sister site, mainstreet.com, I actually helped them create a pot index, which we set the baseline at 420. Figured that was a fitting number. So just following the group as a whole, you've definitely seen the stocks do very well since the beginning of the year, and obviously have come back a lot. It's because these stocks are so volatile. I tend to focus on the larger ones, like a GWPH, which is actually doing very well today. And because it's a cap-weighted index, will actually drive our index much higher. But in general, with stocks under 10, we have a minimum market cap of $100 million. So that does unfortunately exclude a lot of the marijuana stocks.
Okay, and do you just have any final tips for investors? I mean, been a great run in the market. You said you were holding cash, a lot of cash. What would make you go to more cash, and what would make you put your money back in the market?
So I don't really want to have more cash than I have right now. I think that when you look at the market, there are always going to be opportunities out there. One thing we've been doing this summer is been running a lot of screens looking for new names. And even if values do feel overinflated, and a lot of the areas in this market do feel overbought, there's always going to be sectors out there, whether it's the biotech stocks, whether it's some of the cloud stocks. And you'll see with Adobe reporting tonight just how the market sentiment is towards that. If you look at the broader market averages, especially the large caps, it's a relatively flat year. Maybe we're up a couple percent. But when you look at the numbers behind that, especially in the small cap space, I think you'll find a lot of value out there. And it really depends on what people are looking for. But me, I'm fundamentally driven first, and I see companies out there with good balance sheets, with good sales momentum, and some of these stocks are down 10, 20, 30%. So I definitely see the opportunity out there, and I think that the Fed is going to remain accommodative for the next 6 months or so. And really, it's really hard to look much further out than that right now. So again, pick your spots. No one's ever really made a profit by chasing, in my opinion, in this market. But I think the opportunities will create themselves.
Okay, we've had David Peltier on from TheStreet.com talking about stocks under $10 as well as dividend stocks. David, thanks for your outlook on the market, and we hope to have you on once again.
Great. Thank you, Joe.